So today, my favorite topic, we'll talk about risk management. We might finish that up today and get into asset valuation. So we introduced risk management last class. I want to give you a typical risk management process. You'll see this a lot in textbooks. You'll see it in corporations. So the first part of risk management is just knowing why you exist. Why does the corporation exist? Why you as a human being? What's your goals in life? What's your mission identification? What is your mission? You want to treat the risks that are core to your processes. If you're taking a risk that's not important to what you are as an organization or as a human being, eliminate that risk. Why take risks that doesn't get you to where you need to go? Once you know what you're all about, what your goals are, what you're trying to achieve, then you can do a risk uncertainty assessment. And that starts with risk identification. And risk identification, my word, has gotten so ridiculous. I remember where I worked, they had over 100 risks identified, and some of the risks they had identified to me were not risk, including the net worth of the firm. The net worth of a firm is not a risk. It's not going to attack you. It's the thing you're trying to protect. So it's not like you woke up one day and your net worth was attacking you and you're like, man, I wish I had bought some protection from that. So it gets a little ridiculous. Firms just list everything they can think of, but we're talking about things that can attack you. Now, an employee can be both a risk and an asset and a value and something that you're worried about. So the employee can do you harm, and an employee can be harmed, but your net worth, that is not a risk. So like assets that you own, they are not a risk, but the stock market crashing 30%, that is a risk. So if you own $1 million in stocks, the $1 million in stocks is not a risk. The risk is that the stock market crashes or the economy crashes, something along those lines, that one of the firms you own goes out of business. So you identify those risks. We're going to talk about, I'm going to give you my list, which is a much shorter list and it's very finance focused. But there are several risk lists out there that are interesting. One of my favorite firms, Capital Research, CMRA, Capital Management Research Advisors or something. Their website is great, really interesting firm, very impressive firm. The two ladies who started it are extremely quantitative people, so they're very intimidating. I remember the first time I met them we were doing a request for proposal. When I met them, boy, I was scared to speak because they were just, their knowledge was just so incredible, and that's their business. Their business is to help firms manage risk. So they have a risk universe. If you go to their website, you'll see their risk universe. Pretty extensive universe. I think some of it's actually tongue-in-cheek, some humorous things that they have, and others are very legitimate risks that they follow. So having a list helps. If you meet with a financial advisor or a financial planner, they definitely have risks. So you got to worry about premature death. You got to worry about getting sick. You got to worry about disability. Worry about your car getting in a wreck or your house catching on fire. Life insurance, auto insurance, homeowners insurance, and then you got to worry about retirement and your kids' education and all these things. So they have these risks that can happen: stock market falling, interest rates rise, inflation, and you need to at least think about them, think about what could go wrong, and then if as much as you can, the rest of this is mitigate, which is where we go after we do the risk assessment. So you have perils. Those are things that are outside, usually, not always, but usually outside, that can do you harm. And then you have exposures. Exposures are those assets and liabilities that when the outside thing hits you or the inside thing hits you, those are the things that are harmed. So an employee can be both, like I said, an employee can be both a peril and an exposure. Exposure is how you realize the harm from the peril. The peril is the thing that does the harm. So an employee can be a peril because an employee as a peril makes a mistake, causes a lot of harm, and then the employee themselves can be harmed, and that creates a liability. You now have to pay for their injuries. Once you know what you're worried about, you have your list of risk, you then do a risk analysis, and there what you're trying to do is understand how the two interact. So maybe oil prices shooting up is a risk. But then you need to sit down, maybe you're an airline, so oil prices shooting up, that means jet fuel prices are going to shoot up. That means our costs are going to shoot up. We're going to have to raise prices, but it's a very, very uh, difficult market right now. Our customers are not going to pay more. Maybe we should hedge that, but if we hedge it, then competitors don't hedge it, and oil prices fall, then we got a risk. You're trying to sit down and figure out how that peril interacts with your exposures to cause you a loss. And then you're going to put numbers to it. Frequency and severity. Frequency is the probability that something will happen. Severity is how bad the loss would be. A lot of firms use what's called heat maps. I do not like heat maps. We had them a little bit where I worked. I don't like heat maps because they're not quantitative enough. They're a little too subjective, way too subjective. But heat maps say frequency, is it likely to happen, highly likely, likely, unlikely to happen, and severity is low severity, medium severity, high severity. But the problem when they have us fill out these heat maps is they don't tell us what they mean by high likelihood and low likelihood. So you might say, well, what's the probability of the stock market falling 20%? And you say, oh, that only happens like once out of 10 years. That's a pretty low probability. Well, 10% once out of 10 years, that's a low probability. But if I'm talking about jumping out of a plane and parachuting, and someone says, you know, how often does someone jump out of a plane that the parachute doesn't work? Is oh, it doesn't happen very often, only about 10% of the time. Well, no, that's a high probability, a high frequency for something as serious as jumping out of a plane. So the frequency and severity, really, you have to tie them together. So it's really, people have different definitions, and to me it's just a mess. You can think of frequency and severity in terms of, say, auto insurance. So let's say you have a 0.5% chance of totaling your car, and your car is worth $30,000. So you have what we call an expected loss, which is your probability of it happening, how much you lose if it happens, frequency times severity, you get an expected loss of $150. That's your average loss. Another way we're going to see, we'll get into this in a little bit, value at risk. You can say your value at risk at a 0.5 probability is $30,000. What that means is 0.5% of the time you expect to lose $30,000. 99.5% of the time you don't expect to lose anything. You don't expect your car to be damaged at all. So we are going to be using value at risk as our main measure, and we'll talk about that. We get to use things like mean and standard deviation to calculate that, but it's a very common tool. Once you have some numbers, so you know, hey, what are we worried about? How does it impact us? And let's put some numbers, some statistics to it. And now we can start doing mitigation. And you start mitigation with risk control. What risk control is you're either trying to eliminate the risk entirely, that's called risk avoidance. You're trying to reduce frequency, that's called risk prevention. Or you're trying to reduce severity, that's risk reduction. So risk avoidance, let's say you have a pool in your backyard, and you're worried that some neighborhood kid's going to come over and drown in your pool, and you have this pool and no one ever uses it. It just sits back there. Well, the smartest thing to do is just fill the pool in with concrete and make it a patio. Now a kid could run and fall and scrape their knee, but that's not as serious as a drowning. So there's still some risk, but the risk of drowning in a pool is now zero. If it's not core to your mission, then eliminate it. If the risk is core to your mission, you cannot do risk avoidance. United Airlines cannot avoid the risk of a plane crashing. It's so core to their business, they have no choice but to take that risk. Now, they can do risk prevention and they can do risk reduction, but they cannot do risk avoidance. Buying auto insurance from State Farm is not risk avoidance. So you could still wreck your car, and when you wreck your car, you call State Farm, you discover they just went out of business. The risk all bounces back at you. That's not risk avoidance. That's what we call risk financing. So that's something different. Risk avoidance is the risk does not exist anymore. So if you want to have risk avoidance on auto insurance claims, people having wrecks in a car, then you'd have to get rid of your car entirely and just not use a car, don't ride in a car, don't do anything in a car ever again. That would be risk avoidance. Risk prevention is, instead of putting concrete into the pool and eliminating the pool entirely, you could put a tall fence around the pool, making it less likely a neighborhood kid can actually get to the pool. There you're trying to reduce frequency. Compliance and procedures like that are ways that try to find ways that say we never want this to happen. So we're going to require our workers to wear a safety belt because we don't want our workers to injure their backs. So wearing the safety belt reduces the probability to injure their backs, so it's risk prevention. Risk reduction on the pool example doesn't work too well, but maybe you learn CPR. So if the kid gets in your backyard and is drowned, but they're not, they're drowning, they're not breathing, you can grab them out of the pool, and since you know CPR, you'll cut the time down, for the paramedics to get there. You can do CPR, maybe save the kid's life. I don't think that's really all that useful in that case. However, the Tylenol example that I talked about earlier, Tylenol used public relations to address their risk. So they'd had a product that had been tampered with, and they got the media on their side by being very aggressive in how they did things. And it actually probably ended up not only reducing the risk, but actually saving the product. Tylenol is still a product today. There was many people when this happened thought that Tylenol would never be sold again as a product. And Tylenol did such a good job of really using the media, the right articles that were essentially propaganda articles. So Tylenol was very forthcoming with the media, shared everything they needed, made it very easy for the media to work with them, and they essentially got the media to tell their story. Well, we're not going to talk about options in this class, but an option is possibly a way to reduce your severity. An option to me is really more risk financing, so I'm not real sure why I put it there, but you could think of insurance and options. These are ways to that when a loss happens, you have something that pays you money to offset that loss. So that's what your auto insurance does. You've lost your car, so the auto insurance pays you money. You could think of that in risk reduction, but I really think options probably fits more down here in the risk financing. So what is risk financing? So you've done everything you can do. And after you did that, you still have some risk left. That's called residual risk. Well, now you need to bring someone else in. You do risk financing. Risk finance means you have someone else that when something happens, they're going to step in and give you money. So insurance is the perfect example of that. Some companies actually use a captive insurance subsidiary. So they essentially insure themselves. That's not really risk financing. That's really just taking advantage of the tax code to get something. So it's kind of risk financing a little bit because you're letting the tax code help cover some of your costs, but it's not truly. So when I buy auto insurance from UTSA or State Farm, I am shifting that risk from me to them as long as they're in business. So that's risk financing. You can do what's called risk securitization. I don't do that in this class, but in my property and casualty class, we talked about risk securitization, where insurance companies can actually use the capital markets to essentially insure big catastrophic type of losses. Letters of credit, that's kind of risk financing. Essentially what that means is when something bad happens, you've got a bank that's willing to loan you money. Now you still have to pay the loan back, but at least you had money at the time you need it. And then finally, it's just risk retention, which means, we looked at outside parties and they were way too expensive. The auto insurance, the homeowner's insurance, whatever you're looking at was just way too expensive. We decided just to retain our risk ourselves. And that's because your ultimate goal is risk optimization. Your goal is not risk minimization. Risk minimization is easy. For United Airlines, how do they minimize the risk of an airplane crash? They just stop flying planes. The goal is risk optimization, which means take on those risks for which you have expertise and you receive adequate compensation. Reduce or eliminate risk for which you are not paid adequately. So the goal is not minimization. That's what regulators want. That's what credit agencies want, is risk minimization. They just don't want you to take risk because they don't want you to go insolvent on their watch. They'd rather you take less risk. But that's not your goal. Risk minimization essentially is just get out of business. Stop doing things. If you hire employees, you're going to have a risk that an employee gets injured. The only way to minimize that risk is to stop hiring employees, but that's not a good way to run a business. So every business takes risk. The question is, are they taking risk in an intelligent way? You take a firm like AIG, great firm, incredible firm, very sophisticated, a premier insurance company. They insure things other insurance companies just don't insure. They're very specialized. And yet in 2008, the firm went under. They had to get a bailout from the government. Why? Well, because they had this one small department doing something they shouldn't have been doing. It had nothing to do with AIG's mission. They were not getting adequately compensated for the risk. They didn't look at the risk they were taking and how bad it could have been in a crisis like 2008. And essentially, all these thousands of employees working for this great company called AIG, they all went under this incredible stress because this little bitty department decided to gamble the entire company. And they did well for a few years. Everybody's saying, wow, this is great. They're making a few $1,000,000, but it's not worth it to make a few $1,000,000 if you're going to topple a multi-billion-dollar company. All right, so there's the process. A lot of firms have this. It's a good exercise to do for a firm, for an individual, to walk through this. You need to do this at some point in your life. So my way of taking this process and summarizing it is I redefine it as define, measure, mitigate. Define is what's your mission, risk identification, analysis, and measurement. Identification, analysis. Measurement is obviously measurement, and mitigate is your risk control and risk financing. You define what is the peril or the exposure, you measure what's the frequency, what's the severity, and you mitigate with either loss control or risk transfer of some time. So let's start with the risk identification. So here's the risk, the most common risk that you'll see on the finance side. And their CMRA, their site, I do recommend their site. They have a universal risk that you can look at if that link still works. They keep changing their website. They call it the galaxy of risk. Most people call it the universal risk. But I'm going to use a much shorter list than they have. So my favorite risk is interest rate risk. That's where my entire career was focused in on, or most of my career, probably 80% of my career was interest rate risk. I love interest rate risk because there's so much math behind it. You can really sit down and accomplish something with interest rate risk. We won't cover interest rate risk in this class. I cover it in my risk management class in quite a bit of detail. The second one is liquidity risk. That's one of the toughest ones of all. Liquidity risk is you need cash and you can't get it. And it can also just mean that markets freeze up. You can't sell anything because there's no buyers. And prices drop dramatically just because there's no buyers. Everybody's just frozen. That happened in 2008. People just stopped buying. Liquidity risk is tough, especially for central banks, because central banks, they look at an AIG, they look at a Lehman Brothers, they look at Merrill Lynch, and these firms in 2008, and they have to ask the question, is this a liquidity risk or is this a solvency risk? Is this a firm that's a perfectly legitimate firm, but they just need cash to hold them over? They just can't get hands on cash because the markets have seized. So we as a central bank will provide a low interest rate loan to them so they can survive. It's just liquidity risk. Or is it bankruptcy risk? Is it credit risk? Is this an entity that's really insolvent? They cannot survive. And if we provide them liquidity, we're just going to make the risk much larger. We're going to lose the taxpayers a lot of money. So central banks need to decide if a particular entity is facing a liquidity crisis, which is a temporary thing, just a need for cash, or are they truly insolvent? And banks, boy, they struggle with that. So with Lehman Brothers, they decided that was a solvency issue. Let Lehman go under. Don't provide them any funds. Let them go under. They might have regretted that later because it caused a lot more damage than they were expecting. We're going to spend our time on price risks and talk about this value at risk, so we'll get into that. We'll spend a little bit of time on credit risk. We won't cover disclosure risk, but disclosure risk is a big one for accountants and finance. and that is just the reporting can be so difficult that you just don't do them. There was a few projects I had where the gap reporting, the accounting reporting was so cumbersome, it almost killed the project. And the last one, operational risk, is a very interesting one. It's a huge one. It covers so many things. I'll just hit it very high level, but it's just everything else. If you're an accounting major, you have a class on auditing and internal controls. That's where operational risk comes in. Internal controls, make sure everything's authorized, make sure you're documenting that you've got a receipt, or you got authorization, you got a signature, that assets are being protected, that they're locked up, that procedures are being followed, all those kind of things. That's what internal auditors do, is make sure firms are managing that operational risk correctly. But let's start with price risk. So remember, we're going to use define, measure, mitigate. Price risk is easy. It's the risk that an asset price falls, our liability value rises, and so you lose money. Interest rate risk is actually a special case of price risk, but because interest rates drive so much of our economy, it's a special case where we have special instruments like interest rate swaps that deal specifically with that risk. How do you measure it? Well, we've already talked about some of these, and some of these you had in your stats class. Standard deviation, very important one. Beta, we talked about beta. Beta is a pretty common one. So we are going to focus our energy on value at risk. And there's three types: parametric, historical, and stochastic. We have one actuarial science major in the class. She'll be doing a lot of stochastic analysis, value at risk. As an actuary, actuaries love stochastic. So what's the difference? Well, parametric is the one we're going to be focusing on. It uses standard deviation to measure risk. Historical value at risk essentially says, run our business for this 5-year period. What if 2007 through 2012 repeated itself? What would that look like in our business? So historical, it's like a simulation, but your simulation is some specific historical period. And then the last one, stochastic. Stochastic, just think of this as a Monte Carlo, a simulation, however you want to think about it. You're running simulations, and you're trying to figure out and stochastic analysis simulation can be really valuable for risks that are really complicated. You got 50 things going on at once, and they're somewhat related, and you have some idea how they're related, but the math is just too complicated. The formula would go on for paragraphs and paragraphs. And so what you do instead is you relate everything as much as you can, and then you just run scenarios against it. What happens if interest rates rise and the stock market falls? What if inflation rises and we go into a recession? Or that you do all these different scenarios. And in fact, historical value at risk is essentially doing simulation, but simulation based entirely on a historical period. You're essentially letting history define your simulations. Duration, convexity are important measures of risk for interest rate risk. So we're not doing interest rate risk, so we won't cover those. I may talk a little bit about duration when we do bond valuation, because it can be really valuable. But our focus is going to be on value at risk. Value at risk uses standard deviation, but we're going to be actually doing value at risk, and we're going to be doing parametric value at risk. If you want to get more into this, you can certainly Google any of these terms: parametric value at risk, historical value at risk, stochastic, and read more about it. We use all three of these in my risk management class: stochastic at a very high level, but the others in a more detailed way. And how do you mitigate it? Well, the number one way we mitigate price risk in finance is through diversification. We make sure we don't have all of our eggs in one basket, as they say. We may have some stocks, we may have some bonds, we may have some international stocks, we may have some real estate. We try to diversify it so when one thing falls, hopefully something else might be up. So in 2008, stocks fell, but U.S. Treasury bonds were up in price. And so, yeah, you lost money on the stocks, but your bonds are up, so you have some diversification, reduces your risk. All right, so let's get back to the measurement, mitigate. Measurement using value at risk is going to be how much we expect to lose at some probability. That is what value at risk is. It's a very simple formula. Mitigation is how much we're allowed to lose at that probability. You might hear this referred to as a risk budget, and that's why I have it set up in the Excel applications and in the exam number 2. All right, so that's the process. You pick a probability. This probability is also known as your risk tolerance. You pick a probability, and once you pick that probability, you then go out and you say, okay, at that probability, how much could we lose or more at that probability? So if you say, well, my risk tolerance is 1%, and I'm worried about the stock market, and so you run your models, you look at your models, and you say, how much can I lose 1% at a time with the stock market? And you do your analysis, and you discover that 1% at a time, the stock market falls 25% or more. So you've got a 1% chance of losing 25% or more of your money. And so your value at risk would be 25%. Your mitigation, you might say, hey, you know what? We're not allowed to lose more than 15%. With a risk tolerance of 1%, we can't lose more than 15%, then we'd be over budget. We'd have to change our portfolio because we're taking too much risk. Maybe we need to add some treasuries to our portfolio to reduce that risk from 25% down to 15%. Now, one thing I do want to do real quickly, I do this in my other class in more detailed. I'm going to do it really quickly here, but you should know all of these formulas. Not just finance majors, all majors, because we use them in all fields. A lot of you have heard of artificial intelligence and machine learning. Machine learning, artificial intelligence uses these statistics significantly. So you really need to know these statistics. Know the formulas, and I would say don't memorize them, short-term memory. Actually know them permanently. And I'm going to try to give you a way to learn them permanently because they're not that difficult, because they all involve step 1, you subtract. Step 2, you multiply. Step 3, you divide by n, you take the average. Then they're a little different, but those first 3 steps are the same. So let me just refresh your memory. Standard deviation. With standard deviation, you only have one piece of data. So with standard deviation, you take xi minus x bar. There's a subtract. xi is, maybe you have 40 months of data, so xi is month 1, month 2, month 3, month 4. You take each month and subtract the average for all the months. So that's step 1, you subtract. Step 2, you multiply, that is, you square it. You take that difference and you square it. Alright, so that gives you great insight to finance and how we define risk. We define risk as how far can you get from the average, and then we square it, and the squaring does 2 things. First of all, we don't care if it's above average or below average. All we care about is how far from the average you can be. So if you have 1 month is the number is 0.32 and your average is 0.2, then you're 0.12 above the average. You might say, wow, I made 32% when on average I make 20. That doesn't sound risky, but with standard deviation we say, hey, if you can be that far above the average, you can also be that far below the average. So standard deviation assumes a very symmetrical distribution. We're really interested in how far you can get from the average, whether it's above or below. So we're going to square it and all negative numbers disappear. Once we get that squared difference, we just take the average of all of those. And then at the very, very end, you just take the square root of that. So standard deviation is you take each point minus its average, you square it, the average of all of those squared differences, and then that's volatility. You take the square root of that, that gives you standard deviation. For the others, for beta, correlation, and R squared, you take xi minus x bar. So again, you take the difference. So we start with the subtraction. Then we multiply, but we don't multiply it by itself. We have to have 2 pieces of data, 2 data streams. One might be the stock market, and the other one might be interest rates. And we're trying to figure out, hey, how do stock markets and interest rates perform? And so the key here with beta, correlation, and R squared, what we're asking is, when X is above its average, is Y also above its average? If they're both above their averages at the same time, we get a positive number. If they're both below their averages at the same time, we get a positive number because we multiply negative by negative. However, if x is above its average when y is below its average, and x is below its average when y is above its average, then we'll get a negative number, and that's where diversification comes in. That's what we like. We like to invest when this one's doing great, when this one's struggling, and then this one's doing great when that one's struggling. We like that. That's a good diversifying asset to have. So then you take the average on all of them for standard deviation. If you do STDEVP for standard deviation, you're dividing by n. If you do STDEV, you're dividing by n minus 1. That's 1 degrees of freedom. Hopefully you remember that from your stats class. For correlation, beta and r squared, you take the average of all these differences, and that's actually called, I don't have it in here, but the average of all of those differences is called covariance. And so for correlation, r squared and beta, they all use covariance. Correlation takes covariance and divides it by the standard deviation of x times the standard deviation of y. R squared is then correlation squared. And then beta takes covariance, the average of these differences, and divides by the standard deviation of the market times the standard deviation of the market. So if y is the stock market, then beta takes the standard deviation of the market times itself. Here we use the, in Excel, you use the function correlation. And, I'm sorry, slope. I got ahead of myself. You use slope, which is what you're doing in your Excel application, I think number 5 or 6. And then for correlation r squared, you use the correl function. There is an r squared function, but I just use correlation and I just square it, and it gives me r squared. So what do I recommend that you do? What I recommend, especially, well, I really think you all need to be able to do this, but especially finance majors. If you want to see how to do this, I've got a video in my other class, email me and I'll show you how to do it. But essentially bring in the data and do these formulas by hand. Do the entire formula by hand off the top of your head. And then check it against the actual formula in Excel and see if you get the right answer. I think it's a great way to actually visualize what these formulas. We use these formulas so much, you really need to be an absolute expert on this formula. If you're in management, cybersecurity, marketing, finance, accounting, we use this stuff a lot, especially with artificial intelligence becoming such a big deal. They all assume symmetry, they all assume normal distributions, and so much of our finance theory is embedded in these formulas. So much of artificial intelligence and machine learning is embedded in these formulas that we really need to know them. All right, so let's get, the only one we're going to use of all of those is standard deviation. So what is value at risk? And here's the formula right here. Very straightforward formula. Value at risk is the mean minus the number of standard deviations times the standard deviation. That's your loss expected at a probability associated with the number of standard deviations. So hopefully you remember some of these number of standard deviations. I think you probably have had that in your stats class. So let's look at them. We're going to do a normal table. And how we set up? We start out at 0 and 0. And then on the top, you've probably seen this in your textbooks. You go across the top. Oh, actually, I think we add 0.01. 0.01 up to 0.09. And here you go up by 0.1. And you go down, I don't know, about 7 or 8. You don't need to go much past 8. So what is this telling us? So what these numbers are, you add them together. So 0 plus 0, what they're saying is how much of the curve is to the right of 0 standard deviations from the mean. Well, 0 standard deviations from the mean is the mean. So you do equal norms dist, and you take the 0, you have to lock in the column, plus the row. So 0 plus 0. And what is that going to be? Obviously, it's 50%. half of the curve is to the right, and as you go across, what happens as you move further and further away from the mean, more of the distribution is to the right. Now this is why I think you've seen this before. You probably remember 1.64. If you remember in your stats class, 1.64 standard deviations, that is associated with a 5% risk. Here we're seeing the opposite side, 95%. So a 5% risk, you're saying 5% is to the left and 95% is to the right. You probably also remember 2.33 would be my guess. Let me put a freeze frame in there. So 2.33, there's 2.33, see how I'm doing that? 2.33, you add those together. So 2.33 is a 1% risk. 0.99, 99% is to the right, 1% is to the left. So you probably have seen the normal distribution before. You normally see it like this, which is a two-tails, two ways. So you say 1 standard deviation plus or minus 1 standard deviation is about 2/3 of the curve. And then as you go out further, 4 standard deviations, they don't even go that far, but 3 standard deviations plus or minus, now they're adding an extra 0.1%, so 34 plus 13, so you can go, so in between tells you how much, 68% is in between. You have to add all these numbers together. So 95% is plus or minus 2, but we're not doing a two-tail test. We're only doing a one-tail. That's what value at risk is. Value at risk is asking, if you go out 3 standard deviations, how much of the curve is to the right and how much is to the left. So if you do 1 standard deviation, that's 84%. So what is that saying? For 1 standard deviation, 84%. So if we went over here, 84% would be to the right and 16% would be to the left. Alright, so that's 16%. That's also 16%, right? 16% over here, 16% over here. So how much is in the middle? Well, if the two sides are each 16%, then the middle must be 68%. So that's how they get that 2/3 is 1 standard deviation. Why? Because 32% is outside of that. So you've seen these numbers before. Our focus is entirely on one side. So if we want to have if we have a 1% risk tolerance, then we're looking at a 2.33 standard deviation event. You just add those numbers together. Alright, so there's your normal curve. You can see how you can build a normal curve just by doing the function. You've seen these in your textbooks. You use the norms dis function, equal norms dis, and you put the number of standard deviations, and that will tell you the percentage of the curve to the left of that, or I'm going to say to the right, because we're focused on the left side. So we're going to say the right is 99% is to the right, so 1% is to the left. We're worried about the downside. We're worried about that 1%. So 2.33, that's 99% is to the right, 1% is to the left. 1.64, 1.65, however you taught it, 95% is to the right, 5% is to the left, and there's no need to interpolate. If you've ever had a stats professor say interpolate, so it's really not 1.65, it's 1.645326. I had a professor do that once. It's like we're kind of just guessing. It's just an approximation to begin with. There's no reason to go out that many decimal places. All right, so let's go through this process, and then you'll see the Excel application, and you'll see how it works. So we're using parametric. This is parametric value at risk. This formula. The first thing we got to do is pick our risk tolerance. Is our risk tolerance 1% or is it 5%? So select your risk tolerance. Now some firms actually express it the other way. If you go to the Goldman Sachs, they say their risk tolerance is 95%. I come from the insurance world. We express our risk tolerance on the downside of the tail because they're worried about losing money, but they express it at 95%. So essentially, the different ways you can express it, you can say, I don't want to lose more than X dollars, more than 5% of the time. 95% of the time, I want to lose less than that. You can express it either way. They're essentially complements of each other. The closer you get to zero, the lower your risk tolerance, the more frightened you are. So someone in their 80s who's retired, they should have a risk tolerance of like 0.2% or something. A young person just starting out and investing their money, they could have a risk tolerance of say 5%. The lower your credit rating, the higher your risk tolerance. So a triple B company might have a risk tolerance of 0.1%. UTSA is a double A company and their risk tolerance is 0.2%. A lot of times the credit rating agencies will tell you what your risk tolerance needs to be because they know what probability you have of going insolvent and that's what you want. For most individuals, age is the most important thing. The younger you are, the more risk tolerance you can have, and I talk about this in my life insurance class. There's a lot you can do. Most Americans use a 1%, younger might be higher or lower. Some people say, hey, all you got to do is just take 100 and subtract your age, and that's how much you put in stocks. So if you're 20 years old, take 100 minus 20, you should put 80% of your money in the stocks. I don't believe that. I think that's a terrible way to think about it. And you can read my blog. I've got a blog on how I think young people should invest, and I don't buy that. In fact, I think someone who's 20 would be smarter putting 100% of their money in stocks, not 80-20, because that 20% is really not doing anything for you. But that's one rule just to show that younger people can take more risk, older people take less risk. All right, so you get a risk tolerance. I give you the risk tolerance on the exam and on the Excel application, so you don't have to do that. I just give that to you. The next thing you do is you run the value at risk. So if it's a 1%, if your risk tolerance is 1%, your risk tolerance is 1%, 1% is not anywhere in this table. So you just know if your risk tolerance is 1%, you take 1 minus your risk tolerance, 1 minus 0.01, and that is the number you're looking for in the table. You find that number, 0.99, and that tells you you're looking for a 2.33 standard deviation. If I say my risk tolerance is 0.6%, what does that mean? Well, 0.6% is 0.006. So you take 1 minus 0.006, you're looking for 0.994. There's 0.994, so 0.6 risk tolerance, 0.6% risk tolerance would be a 2.51 standard deviation event. We actually call it, it's a 2.51 sigma event. So some people use the word sigma, but that's the risk. That risk tolerance is going to allow us to go further out on the curve than if our risk tolerance was 1% versus if it was 5%. So that's how we get the number of standard deviations. If we have a 1% risk, we're going to use 2.33 here. I give you the risk tolerance, I give you the mean, I give you the standard deviation. All you've got to do is figure out the number of standard deviations and plug it into this. Now when you do this formula, you will get a negative number, but we always express value at risk as a positive number. We just know it's a loss. So our value at risk at 1% is $30,000. We know that's a loss. We're not saying we have a 1% chance of making $30,000 or less. We have a 1% chance of losing $30,000 or more. So in Excel, you can do norm.s.inv and put your risk tolerance in there, and that will give you the number of standard deviations. If you want to double check, let me show you that to you really quickly so you can see how the two interact. So let's say norm.s.inv, and let's say, oh, my risk tolerance is 0.9901. Hit enter, I get the 2.33. All right, maybe my risk tolerance is 95. So here you've got to do, you can't do the 1% and the 5%. You have to put it the number that's in this table. Now you can do minus that and do 1%. If you do that, then you do get to 2.33. So if it's a negative number, they know to go to the other side. So if you want to put in the lower probability, then you start it as minus norm.s_inv. If you're using the higher number, the 99% or whatever, 95%, say 0.98, that's 2.05, 2.005, there's that 98%, somewhere between those two. Then you compare your VAR to your risk budget. If your VAR is less than your risk budget, you're fine. You could even take more risk. If your VAR is higher and someone's in trouble, you got to reduce your risk somewhere. You could cheat and just change the model. I've seen people do that and say, oh, you know what, my model, my standard deviation is too high. It's not 15%, it's really only 13%. It reminds me of one of my favorite sayings, all models are wrong, some are useful. And it's because, yeah, there's so much fudge factor in these models, you can almost get whatever answer you want. So you've got to, don't do that. Stick with your model. If your model says you're violating, don't change the model so that you get to do what you want to do all along. Stick with value at risk. Your risk budget could be your net worth. So you say, I don't want to go bankrupt. That's called risk and ruin analysis. For individuals, it's pretty subjective. We know what risk budgets are. It's up to each individual. All right, we have some examples down here. I'm going to let you do these examples. What I want to do is I want to go to the actual Excel application so that you can see exactly what you're doing. All right, so we're up to Excel application number 8, the value at risk one. There are 3 problems, and they're going to look very much like this on the exam, so this will be good practice. This tends to be the easiest question. I don't think many students miss this on the exam because it's very straightforward. But your goal is just make you aware of value at risk by working some simple problems. It can get much more complicated. In my risk management class, we bring in, and I'll show you. I'll talk about how we bring those in using an extra formula, but bring in correlation, other asset class. There's a lot more you can do with this and can get quite complex. So this is just the basics. So you're going to have to use the normal table that I just showed you there. So you can use the formula. So let's do problem 1. I'm going to copy this over. The Merkel company, I guess I named this after Germany's Prime Minister. Merkel has a proprietary trading desk. You don't have to worry about what that is. A proprietary trading desk just means this, investment banks used to have this, and the Dodd-Frank bill essentially shut it down. But banks trading for themselves just to try to make money in the market. So they have a proprietary trading desk. The value of the portfolio, that's going to be important, is $1.5 billion. The operation has a daily risk budget, so our risk budget is $150 million. And we have a risk tolerance of 0.3%. And we have a standard deviation of 4.3%. Alright, so let's calculate the value at risk, 0.3%. And so remember, the formula is going to be the mean minus the number of standard deviations times the standard deviation. So what you have to figure out is the number of standard deviations. How far is a 0.3% risk tolerance from the mean? Okay, it comes back to here. We're trying to figure out, there's 1 standard deviation, there's 2 standard deviations, there's 3 standard deviations. How much do we need so that we get 0.3% of the curve to the left and 99.7% of the curve to the right? So you can use the minus norm.s.inv function and just click on that 0.3%, and there you see it's 0.274275. Or you can take plus 1 minus your risk tolerance, and that's 0.997, and then you can go to the table, and in the table look for 0.997, and there it is right there, 2.75. 2.75. That's essentially the number we got there, although this one will be more accurate because it goes out several decimal places, so you can interpolate if you want to if you're using Excel. So let's do the formula. It's very straightforward. The mean is 0. I forgot to put the mean in there. Let me put the mean in there. Move this down a couple rows. So the mean, anytime you're doing a daily type of value at risk, the mean is always 0. Your expected return on any given day is just 0. That's true for the stock market, for just about anything. It's just 0. So let's do our formula. So we've got the mean minus the number of standard deviations times the standard deviation. And remember, we do that as a positive number, so I'm going to use the absolute value for that. When we do that, we get 11.82%, but our budget's in dollars. So how do we do VAR in dollars? We just take our value at risk times our portfolio value, and there's our value. And so then we have to do the assessment. If you want to use an if function on here, you can say if my VAR is greater than my risk budget, then you have something that says failed VAR exceeds budget. Or if it's not, if it's less than, and you say, I don't know, the opposite of fail is acceptable VAR is below risk budget. Something like that. I don't really care about the exact words as long as you say something like that. And so here we have our final solution here. So this is really what I'm looking for here. This is the answer we need. I don't need the formula over there, but that's the answer that we're looking for. So very straightforward. You just plug numbers into a formula. Can't get much easier, more straightforward than that. I have done this in my career, this simplistically. It can get much more complex than that, but I have done it that simplistically. If we have time at the end of the semester, we might come back. We'll see. I want to make sure we get through everything, and plus I want to, at the end of the semester, we might work a few of these just for some practice. They're a little more complex. I think you can figure them out on your own if you just work through them, so I encourage you just to try it. Now, that was the entire portfolio. What if you're trying to decide of, I got these 10 things I can invest in, what do I do there? Well, that's where correlation comes in. So if you're looking at, hey, can I invest in stocks and bonds and real estate, you now have to look at correlation. Do they all move together? Do they all crash at the same time and they do extremely well at the same time? Or are some up and others are down? Correlation is what reduces your risk. When things are not perfectly correlated, it reduces your risk. This formula here, we're not going to use this formula. And I'm not going to do this. This is another thing we'll come back to if we have time. If you take my risk management class, we definitely do all of this. But this is a very, very famous formula in Excel. In finance. to figure out if you got A and B, and you want to know how risky they are if you can put them together. Well, you say, well, what's my weight in A? How much do I have in A? I'm going to square that. What's my risk of A? I'm going to square that. Plus, how much I have in B? I'll square that. So you might have 20% in A, 20% in B, standard deviation of B squared, and then you take 2 plus the weight of A, weight of B, standard deviation of A, standard deviation of B, and the correlation of A and B. If correlation is 1, then the risk of this is just the weight of A times this risk plus the weight of B times this risk. There's no risk reduction whatsoever. But as correlation drops, it can go from 1 all the way down to -1. As correlation drops, then you'll get different answers. And there's maybe some optimal allocation between A and B that meets your goals. Now, if you have C and D and E and F, you have to do this formula for every possible combination. So A and B, A and C, A and D, B and C, B and D, C and D, all those combinations. So, but you can build the efficient frontier using this formula. If you're really, we're coming up to the end of the semester, so I'm having to drop a few things that you can learn on your own. I would encourage you, my risk management class, I have a video, a part of that class. If we don't get to it in this class, I'd encourage, especially finance majors, contact me and I'll send you that link, and you can see how to build an efficient frontier in Excel using this formula. It's pretty powerful stuff. So that is my mitigation, is I try to find things that are not correlated, and that will reduce my risk. So like gold. Gold has a low expected return and very high standard deviation, but gold tends to do well when everything else is blowing up. Gold it can rise 20-30% if the world's in a crisis. Long-term treasury bonds, especially in 2008, yeah, they have a low expected return and they're very volatile, but in a year like 2008, they could be up 30-40%. They could provide a tremendous amount of protection. So in a crisis, they do really, really well. So you might say, wow, the risk is really high, but when you put it in this formula, that negative correlation is actually going to be in your favor and is actually going to make it reduce your risk quite dramatically. All right, so more examples. If we have time, we'll come back to them. So low correlation means risk reduction. It means good diversification. During a crisis, that may not work so well because correlations tend to rise in a crisis. So, you might think you have risk protection, but then everything sells off in a crisis, except for gold and long treasuries. So you might have some non-U.S. stocks. You might have some corporate bonds. You're trying to diversify. In a year like 2008, everything just crashes 30-40%. We already talked about the 3 ways to calculate VAR. I'm going to skip this. You can just read that on your own. All right, what we'll do is we'll finish up quickly. We'll finish up risk management next class and definitely get into asset valuations. We'll spend the last part of the semester talking about asset valuations and get to those last 2 Excel applications. So we'll talk about credit risk real quickly, operational risk real quickly, and then we're into asset valuation. And there's some stuff at the very end of the class that you can read on your own. We probably won't get much past, well, I might hit just a couple of those real quickly. So we're getting close to the end of the notes.